Most people think successful investing means being active, following the news, checking the markets every day, moving money around, and trying to avoid the next big crash. But the reality is, this is exactly how many investors destroy their returns. In this video, I will share with you how lazy investors with a good strategy easily outperform hyperactive investors, and why doing less can actually make you richer. By the end, you will understand how to avoid the key mistakes that can decimate your returns, and why the best thing you can do for your portfolio most of the time may be absolutely nothing. Which is great news, because doing nothing is one of the few very advanced financial strategies you can practice from your couch. Okay, let's take a look at the topics I will cover today. First, why investors feel they must be active. As you will see, the answer is in human psychology. Second, why boring outperforms exciting in investing. And here I'll show you some really interesting data. And third, 5 simple rules for lazy investors. Rules that can help you get better returns with less stress and less wasted time. So let's start with the first topic. Why do people feel they must constantly do something with their investments? Now, there are 2 main reasons for that. The first one is when you take action, it feels responsible. If some expert says a recession is coming and you sell most of your portfolio, it feels like you are taking control. If the market is going up and you buy more of what is currently very hot, it feels like you are a genius, until you realize you have just bought the top. Doing something feels you are in control. Doing nothing feels almost irresponsible. For example, when the market is crashing, your brain screams, "Do something, you idiot!" And of course, you start to trade like a maniac and sell in panic. Why? Because the human brain was not designed for investing. It was designed for survival. Thousands of years ago, if you heard a strange noise in the bushes, the smart thing was not to sit down, open Excel, and calculate probabilities. The smart thing was to run, without thinking. And over centuries, our brain learned one very important survival rule. When danger appears, act fast. And this instinct is very useful when there is a real physical danger. But in investing, this subconscious rule becomes one of our biggest weaknesses. And the second reason why we feel we need to constantly be active is our environment. We live in a world where everything is designed to keep us excited. Social media gives us a new drama every few seconds. Financial media is scaring you all the time. Why? Because calm investors don't click. Scared investors do. Fear gets clicks, and clicks are their source of revenue. For example, nobody will click on this headline. Long-term investors should stay disciplined and not overreact today. But everybody would click on that. Billionaire investor warns, market disaster is coming. And that is why investing can feel like a casino, even when it doesn't have to be one. The financial industry profits from your activity, and especially from your hyperactivity. Brokers like activity because when you trade, they earn more in fees. Media companies like activity because they get more clicks. But we, as investors, we don't profit from activity, and especially not from hyperactivity. But we can only profit from being calm and a bit lazy. And that is a very important difference. In investing, short-term problems are usually solved with time. Markets fall, markets recover. Good companies have bad quarters, and then they grow again. The stock market has a long history of going up over the long run, and later I will explain why that happens. In fact, for people who invest patiently, the stock market has been one of the greatest wealth creators in history. But many investors never allow this process to happen. They constantly interrupt it by getting in and out of the market, panic selling, chasing hot trends, and changing strategies all the time. Let me give you a simple analogy. Imagine you plant an apple tree in your garden. You water it, you check if there are any pests, you maybe even talk to it a little bit, because who knows, maybe apple trees like motivational speeches. And then the next morning, you walk into the garden, you look at the tree, and you say, no apples yet. That's strange. And then you dig it up, and you check the roots, and you water it some more. The next day, still no apples. And you say, maybe it needs a different fertilizer. So you go to a store and buy an amazing new fertilizer called Quantum Apple Booster. The next day, still no apples. And after 2 weeks of messing with the tree is dead. And you say, this gardening thing just doesn't work. Maybe I should go into quantum computing instead. At least in quantum science, you can have a Schrödinger's tree that can be dead and alive at the same time. Now, let's take a step back and identify the real problem. The problem was not the tree. The problem was you, your hyperactivity and lack of patience. And that is exactly what many people do with their investments. They check their portfolio 29 times a day, they react to every scary headline, they buy an investment and then sell it because some guy on YouTube says, market crash tomorrow. And the funny thing is, that guy has been predicting a market crash every week for the last 7 years. And while he was doing that, the market went up 200%. And then they wonder, why am I not getting rich? Now here's the uncomfortable truth. Most investors don't fail because they do too little. They fail because they do too much. Let me summarize. Investors feel they must be constantly active because A, action makes them feel safe and in control. And B, because our environment is conditioning us to be hyperactive. But in investing, being active and being smart are not the same thing. In fact, the opposite is true. The less you do, the better returns you can get. And now let's move to the second topic and take a look at some data that will show us the proof of that. Why boring outperforms exciting? One of the most extensive studies on investor performance was done by finance professors Brett Barber and Terence Odean. They later called it Trading is Hazardous to Your Wealth. They analyzed more than 66,000 real investor accounts at a large US broker. They looked at actual trades and actual returns over several years. And then they compared investors who traded a little with investors who traded a lot. The results were very clear. The more investors traded, the worse they performed. The most active traders earned around 50% lower returns than the least active investors. So, the investors who tried the hardest to beat the market and spent the most time trading and doing so actually did the worst. And here is something important. This study measured investment returns, but it did not measure the value of all the time people lost while trading. Active traders spend hours watching markets, reading news, checking charts, and stressing about every move. And then, after all that, they get worse results. So, if the study also included the value of lost time, the results would look even worse for active traders. Because active trading doesn't just cost you money, it also costs you time. And that is why lazy investing is so powerful. You can get much better long-term returns and save a lot of time. Time you can spend with your family, time you can spend building your business or learning new stuff. Now, trading is hazardous to your wealth is just one of many studies that all show the same thing. For example, Dalbar's study found that in 2024, average stock market investor earned 16.5%. Sounds great. But the basket of 500 biggest US stocks returned 25%. That is a gap of 8.5 percentage points in just 1 year. In simple terms, if you did nothing, you outperformed by 33% the most active investors who were getting in and out of the market trying to predict every move and the next hot stock. Now, let me show you what this means with real numbers. Let's say you have a $100,000 portfolio. It can be also 1,100 euros or pounds or any other currency, of course. In 1 year, based on Dalbar numbers, the average active investor would grow their portfolio to about 160,000 euros or US dollars. But the lazy investor would grow it to about 125,000. That is a difference of around 8,500 in just 1 year, and this means that average active investor captured about 1/3 less return than the lazy investor who simply stayed invested. And now imagine this performance gap continues for 10 years. Of course, 25% return per year is not realistic over the long run, so let's use a more conservative example. Let's say the market grows 10% per year. This is the historical average for the stock market. After 10 years, the active investor who gets 1/3 less in annual returns, and we just saw that this is very real from the studies, would have about 189,000 on his account. But the lazy investor would have 259,000. That's 70,000 difference, and we didn't even include the value of lost time for active investors. Imagine what this 70,000 could buy you. Several amazing family holidays, part of your child's education, or simply more freedom and peace of mind. And this is the power of having a good strategy and letting compounding do its thing. But now you may say, Robert, this all sounds great, but what if I start investing now and there is a huge market crash next year? Yeah, I know. Many experts have been predicting the biggest crash in history every single year since 2014. But here is the strange truth. If you are investing regularly, a crash is the best thing that can happen to you. Why? Because you can continue buying when prices are lower. And if you buy when the prices are lower, you can expect better long-term returns. Because over the long run, the stock market will very likely, most likely, continue to go up, unless aliens invade. Now why? There are two big reasons why stocks go up over the long run. First, the global economy grows. Companies create new products, they enter new markets, they increase profits, and they become more valuable over time. And second, governments and central banks keep creating new money. This is money printing. And that money, sooner or later, ends up in the markets, in the real estate market, in the stock market, and so on. Now, this doesn't mean markets go up every single year. They don't. There are corrections, there are painful periods, but over the long run, these two forces have been very powerful. And I will explain both of them in more detail in another video. If I summarize the second topic, investors who trade more usually perform worse because every extra trade creates another chance to buy too late, sell too early, panic, or chase whatever is already hot. That is why lazy investing outperforms. Not because lazy investors know the future, but because they make fewer emotional mistakes and give compounding enough time to work. And now, let's look at 5 simple rules for lazy investors. By following these rules, you will very likely outperform 95% of investors while saving a lot of time and emotional drama. And if you don't follow them, well, your broker will probably send you a thank you card. So, if you want to become a better investor, remember one simple word: chill. C stands for create a solid strategy. Lazy investing only works after you know what you are doing. You need to know what you own, why you own it, and how much risk you can take. That is why my 8,000 members and I invest most of our money in low-cost ETFs. They give us broad diversification, low fees, and a simple long-term foundation. If your portfolio is full of expensive funds that have very high management fees, random stocks, and investments you don't really understand, you may be doing something wrong. This is not lazy investing, this is donating your money to the financial industry. Second, have a written investment plan. When markets are calm, everybody says they are a long-term investor. But when the markets fall 10%, 20% or more, and that happens quite often, emotions take over. That is why a written plan protects you from making emotional decisions at the worst possible moment. So, write down what is your strategy, how often will you invest more, and what will you do when markets fall. Spoiler alert, you should add more to your investments. Third, ignore the noise. And by noise, I mean daily headlines, market predictions, scary YouTube thumbnails, and experts who explain the future with absolute confidence. This information does not help you make better long-term decisions. It only makes you nervous. Remember, if you want to be successful in investing, your goal should not be to do more. Your goal should be to do the right things and then give them enough time to work. Fourth, look at your portfolio less often. Checking your portfolio every day creates stress, not better decisions. If it's up, you feel smart. If it's down, you feel worried. And if it goes down 2 days in a row, suddenly you start questioning your entire life. It makes basically zero sense to check your portfolio daily or weekly. Zero sense. And fifth, let regular investing do the work. You don't need to guess the perfect moment to invest. You don't need to predict what will happen next week in the markets. You simply invest regularly and let the system work over time. The lazy investor does not win by being lucky. He wins by being consistent for years. Okay, let me recap. In this video you learned why investors feel they must be active, why boring outperforms exciting in investing, and what are 5 simple rules for lazy investors who outperform most experts. If this video helped you and made investing feel a little simpler, click the like button. That tells YouTube to show it to more people who are still checking their portfolio 19 times a day and calling it research. And of course, subscribe to the channel so you will get more simple, practical investing lessons for busy professionals who want their money to work for them hard, without short-term trading, market panic, and Wall Street nonsense. See you in the next video.